Thank you for joining us today for a Galvanize climate conversation. I'm Kate McMahon, Head of Investor Partnerships here at Galvanize Climate Solutions. Galvanize is a climate-focused global investment firm. We integrate expertise across investment, climate impact, market development, talent, technology, and policy with the aim of driving material climate impact and creating long-term value for our investors. Today, I'm extremely excited to introduce Seth Kirkham, CIO of Galvanize Global Equities, and Neal Kemkar, SVP of Policy and Regulatory Affairs, for a conversation on the investment opportunities in the new era of global climate industrial policy. Please drop your questions for Seth and Neal. If we have time at the end, we'll answer as many questions as we can. So without further ado, I'll let Seth and Neal take it from here.
Thanks, Caitlin. I think before we dive into the consequences of new industrial policy, it's worth putting some perspective and context around where we are from a decarb perspective. Obviously, the Paris Agreement was signed by 194 nations, and now we have over 100 of those, I think, who have put the net zero commitments into national law. But within that, each nation is pursuing different policies and regulatory frameworks in order to encourage their countries', public and private participants to deliver on those net zero goals. Each public and private body is establishing new infrastructure, new value chains, new incentives, new disincentives in some instances to meet these goals. And inevitably, because it's a transition, we're moving from one level of technology to another level of technology. And this is quite consequential in terms of what materials are needed. If you think about a solar field or a wind turbine field, clearly you need very different value chains and very different technologies and very different primary materials versus building a coal-fired power station or a gas-fired power station. What the world is committed to do here really is replace centuries-old infrastructure in the space of 20 or 30 years. Later on, we'll talk about the quantum in terms of dollar and cents of this upheaval to the global economy, but truly this is the biggest change we've seen to global industry since the Industrial Revolution. And those of you that listened in history class all those years ago, that was 300 years ago that we saw the Industrial Revolution. On a country-by-country basis, the consequences are different. And so we as investors have to think about those policies and consequences as we deploy dollars. As I mentioned, there's sort of two broad camps here. We have those companies that are pursuing stimulus, and I think the US personifies that, and those countries that have used penalty. And over the most recent history, that's been Europe's approach in order to encourage reallocation of capital towards these technologies. In the round, though, I think both of these methods of encouraging behavior are a massive driver of capital deployment. The global economy is going to be really impacted by this. And again, I'll give you some numbers about that later, but this is a topic that no investor can ignore. There are huge rewards for companies, and as a consequence, there's huge rewards for investors who follow these dollars. But as I've said, these are idiosyncratic changes that are relevant industry by industry and country by country. And so to harness those returns, you have to be very focused. It's certainly my belief, and I think most of us at Galvanize Climate Solutions would agree, that we're in the middle of a transition that's as significant as the technology transition we've seen over the last 20 years. And anyone that's invested in those markets, and I have, it's very obvious that during that preceding period, returns were dominated by the technology transition that I mentioned. I think that's going to happen on a going forward basis with the energy transition. So I'm really excited to have the opportunity today to discuss with you our approach and our thoughts around this new industrial policy. Given a lot of this policy, though, and we'll get into the specifics of that, are new, I think it's worth discussing a little bit as to how persistent they will be. As we all know, politicians are fickle and regulation can change. The Inflation Reduction Act of 2022 really kicked this all off, an incredible achievement by the Biden government, one that is substantial in terms of scale, ambitious in terms of breadth. In Europe, we had the New Green Deal and the Repower EU Act that were a little underwhelming, but we're in the middle of debating a Net Zero Investment Act in Europe, and we'll talk about that later, that could also be substantial. But how much of this will persist, and how much can I as an investor rely on that capital to drive the returns of the companies I'm investing in? For me, it's a great opportunity and thrill to have Neal at Galvanize Climate Solutions. These topics require obviously deep understanding of networks in Washington and beyond, and deep understanding of the political machinations that drive change. So I'll pass it over to you, Neal. How much can I, as an investor, and the companies that I'm invested in, rely on the dollars behind these programs?
Hey, thanks, Seth, and thanks, Caitlin, for the introduction. Always appreciate the partnership here at Galvanize, and happy to be with you today. So, Seth, look, you're right. The significance of the transition that that's underway right now, both in terms of decarbonization across every sector of the economy, as you talked about, as well as the policy support for it, simply can't be overstated. So, to your question, I would say the Inflation Reduction Act is here to stay. The questions about durability, of course, are understandable, given what we're hearing from congressional Republicans who didn't vote for it, campaigned against it, and are now talking about both repeal efforts and aggressive oversight hearings. But look, to be sure, we do expect committees on the Hill to make a lot of noise around how the administration is implementing the law. But I like to say we really need to focus on the signal here and not the noise. And so the signal is that this is a very durable law. And actually, it's a part of a very durable set of climate-focused laws that we can come back to. But staying focused on the Inflation Reduction Act for a moment, there's a few key reasons to really believe in its durability. The first is that it is legislation, not regulation. So, I've been at this like you for a couple of decades, and, I've seen a lot of different attempts at this. And so most recently in the Obama era, climate policy that was enacted via regulation, it was vulnerable to future executive branch rollback efforts, and that's exactly what we saw. So the IRA, having been passed through legislation, would take a new act of Congress to be undone. And during the next 2 years, at least, with a Democratic-controlled Senate and a Biden administration, that's not going to happen. And so longer term, we think the IRA is durable because it's going to be popular legislation, and we're already seeing that. And why? So first of all, it provides incentives for a broad range of technologies. Yes, wind and solar, but also nuclear and carbon capture, amongst others. And then there's the economic benefits. In roughly the 6 months since the IRA was passed, we've seen tens of billions of dollars in renewable energy, battery, electric vehicle project announcements. And actually, roughly 2/3 of those have been going to Republican-held districts. So if you think for a moment about the manufacturing expansion, job growth in these districts, and frankly, in every district, in every pocket across the country, it becomes incredibly hard to undo. And we're likely to see even more investments announced once agencies provide critical guidance on terms that were left open by the legislation itself. Give you a couple examples. Based on our conversations, we expect the IRS to clarify pretty near term, actually within the next month, just to give you a couple of examples, what it'll take to qualify for the hydrogen production tax credit, what it'll take to meet some of these domestic content and critical minerals requirements for the EV tax credit, and several other key pieces of guidance. And with each additional guidance document comes a clearer and clearer signal for the private sector to respond to. And as we respond, the law becomes more durable still.
Yeah, I'll jump in with a question, actually, Neal, because I promised the audience that we talk about sizing this tailwind. And we see much commentary in the press and from market commentators that this is a $400 billion funding bill, which is a large number, but in the context of a $100 trillion economy, it could be bigger. And yet when I speak to a lot of the companies we're invested in, they talk about elements of the bill being uncapped, and there being much larger opportunity sets than you would get to if you added up just the 400 billion.
Sure, happy to, and it's quite a significant point. So to back up, one of the requirements of the congressional process is that the nonpartisan Congressional Budget Office scores the impact of a proposed bill to the U.S. Treasury. Basically, what's it going to cost? And in the case of the IRA, the CBO estimated the impact of new sources of revenue, like the new corporate minimum tax, excise on stock buybacks, and so forth. And it also estimated that 400 billion number that we commonly use, that you just quoted, as the combined cost of all the new energy and climate spending and tax incentives. But it's just that. It's a good faith estimate. And as you rightly point out, many of the tax credits that ended up in the final bill are uncapped. So the total value of those incentives, and therefore the cost to the Treasury, ultimately will be based on how many units of a certain good will be produced, how much upfront capital is spent. Or another way to think about this dynamic is that the actual value of the incentives is really limited primarily by the private sector's ability to respond to the policy signal over these next several years. So Credit Suisse has a good analysis here. It shows as many as 2/3 of the IRA credits are uncapped. And as a result, its estimates say the total federal spending out of the IRA alone could be over $800 billion. But as I mentioned earlier, there's also other bills that are out there that work in a complementary fashion. So Galvanize, we put together a chart showing how the recent bipartisan infrastructure law and the IRA work together to provide $800 billion in support using just those conservative CBO estimates that we talked about. You can see here on the page just how many different types of incentives there are, Seth. Whether we're talking about electricity, transport, industrial, buildings, or agricultural sectors, or even the nascent carbon removal sector all the way on the right. And add to that an additional $300 billion in loan authority to the DOE Loan Program Office, which we represent in that horizontal bar at the bottom. And then one thing I'd add here that's not actually on this page and sometimes gets less focus in this context, Seth, is the CHIPS Act. So that has an additional $55 billion nearly for semiconductor chip manufacturing, which, as you know, has become an increasingly essential component in EVs, building electrification, renewables, electric transmission infrastructure, and so forth. So, really that $400 billion number by any measure understates the level of support by an order of magnitude.
Thanks, Neal. I think that's a great example about how the extent of your research can be really valuable to an investor like myself deploying capital. And it talks about why we're so excited to be active investors behind this thematic. Understanding where those uncapped opportunities are is really important. We have a solid waste company in our portfolio that is doing good by capturing the escaped methane from landfill because there's a renewable natural gas opportunity there, which now has an uncapped RIN attached to it. And I think can grow the cash flow for that company, for example, by 30% over the next 2 years. And we're hearing that a lot from many of our companies, that actually the opportunity set inside the IRA is a duration opportunity. I think we should shift context a little bit here and talk about the geopolitics of this as we try and attack a little bit of the problems that Europe faces in responding to the IRA. This issue has obviously been, doubled by a post-Ukraine world where energy security and sustainability now go hand in hand. And so these programs are, really very material, and the response to the US has become, very pertinent from an EU economic perspective. I've heard commentators talk about the US economy holding up better, and as many of the people on the screen here will know, the lead indicators have inflected in the global economy and specifically, within the US economy. And it may well be that the fiscal spend that we're seeing in the transition is holding up the economy. That the Fed put that we all relied on to support equity markets now has been replaced by a fiscal put. We've even heard talk about the US potentially weaponizing, fiscal policy, and the European nations are forced to respond here because of competitive reasons. And that's something, frankly, Neal, we're hearing back from our companies in the portfolio. As an example, we have a German chemicals company we're invested in that has polysilicon assets both in the EU and the US. Then in the EU, they faced obviously extreme volatility in the energy price over the last 12 months. And in the US, they face a situation where a potential expansion of that facility would get a 30% tax credit up front. And when we speak to them, obviously their attention is refocused, and that's very scary for European politicians and regulators alike. So let's talk about that European context. As I see it, there are sort of three energy issues that Europe is facing right now. The first is really pertinent to the transition, and this is the reliance on China for many of the minerals and engineered products that are required to deliver a shift towards renewable power generation. I think we have another chart to share with the audience here. On the left-hand side, you can see that in many instances, the availability of the ores required to deliver the energy transition is as concentrated as the hydrocarbon world is, and in many instances actually more concentrated. But what's more relevant and is being responded to in certainly already the IRA, and we believe in the NZIA, the Net Zero Investment Act, is the concentration on the right-hand side of the processing of these ores into the secondary and tertiary materials required for the transition. In rare earths, for example, I think you'll see that nearly 90% of the processing of rare earths takes place in China. I have this anecdote that actually even in the Seoul rare earth mine in the United States, the ore that they're extracting is sent to China to be processed. That processed material in many instances is then sent to Japan to be converted into a permanent magnet. That magnet will then be shipped back to Europe or the US to be put into an assembled vehicle. So by the time you get an EV, that magnet itself may have traveled 50,000 kilometers. This is a situation which is highly complex for a territory like Europe that has very few natural resources. The second problem is a lack of gas supply, and that's caused, like I said, extreme levels of energy price volatility, and most of it upside volatility. Industry finds it very difficult to price and be globally competitive when it can't predict its fundamental, energy cost. And that's something that also the transition will help to resolve. This is a sort of single opportunity for Europe to get that energy security that I mentioned earlier, if they can manage to deliver the industrial complex required to build the wind turbines, the electrolyzers, the solar cells and modules that will enable the continent to harness that renewable energy source. And then finally, just delivering on, moving towards a renewable power generation system is complex in itself. And part of what I think we'll see on the 14th of March and 16th of March, as Europe reveals its new plan, is how they're going to deal with a lot of the legal and regulatory requirements to get these large pieces of infrastructure installed. Germany has spent 10 years trying to build an interconnect between the north, where you have North Sea wind available, and the south, where you have the industrial landscape that consumes that energy, and has still failed to do it. This is really, really complicated, and they're trying to do it in a period when now the US is spending billions, hundreds of billions of dollars to build their own renewable and transition economy. So I do worry a bit. I can't deny it that the policies like the IRA are potentially in breach of the WTO, and that we have a risk of a political risk of these I guess being rolled back because there's other countries that have opposition to them, Neal.
Yeah, Seth, look, you're spot on with that fear and analysis. And it actually did seem like for months that some of the stronger elements of U.S. industrial policy that you mentioned that were embedded in the IRA really ruffled feathers across the Atlantic and sparked debate about just what the response ought to be coming out of Brussels to remain competitive. And certainly some sort of retaliatory response devolving to a trade war of sorts was a rumored possible outcome. But what we heard from Commissioner von der Leyen last month at Davos was just far more encouraging. We actually heard the outlines of the EU's own plan to incentivize decarbonization across the economy over the coming years. We heard her say, quote, "Our plan is to make Europe the home of clean tech and industrial innovation on the road to net zero," and lay out really a sweeping vision for the Green Deal industrial plan. That plan, in broad strokes, is supposed to attract manufacturing innovation to the EU with 4 pillars: one around simplifying the regulatory environment, one around financing, another on sort of skills and workforce development, and a final around trade issues. And just focusing in for a moment, Seth, on that simplified regulatory environment, we actually heard reports this morning, so this is really timely, from the EU about leaked details around a couple of those proposals. You mentioned the Net Zero Industry Act, that thematically has been out there for months, but the leaked proposal from this morning appears to really be a significant piece of industrial policy. It looks like it's going to set targets for manufacturing capacity for solar, wind, heat pumps, batteries, even electrolyzers, that you mentioned. And also some really ambitious time limits around project permitting. The Critical Raw Materials Act, which is supposed to be a corollary, also appears to have some really aggressive domestic targets for supply of strategic raw materials. We can come back to that. And look, we'll be looking out for additional details and any regulation, it has to be noted, still needs to go through agreement and adoption under the regular decision-making process, including Parliament and Council, before it becomes really binding upon member states. But today, I think we should highlight for the audience that what we really have is the beginnings of a global race to the top in climate industrial policy. This is a period of competition, not retaliation. And that's great news for the investment landscape and certainly for the planet.
Yeah, I think you alleviated some of my concerns a week or two ago after you came back from a conference in Colorado that perhaps you should share with the audience, where we're starting to hear actually early evidence of collaboration, beyond competition, actually collaboration, particularly with respect to the buying of those critical raw materials and building buffer stocks of critical raw materials.
Yeah, no, that's right, Seth. Look, at Galvanize, we're privileged to be part of some conversations that help set the agenda. And at this particular gathering of policy leaders, investors, advocates, really that through line of ensuring transatlantic dialogue and cooperation around this space and the entire climate industrial space was a big focus. So you mentioned earlier the WTO issues, and Europeans, in fact, did outline several IRA provisions that they took issue with. Around the renewable energy investment and production tax credits, and that were conditioned on the use of U.S. steel and iron, and even to some extent the EV tax credit with domestic content requirements, and that we all know how important that is for the European market. But at least initially, Seth, it looks like those complaints aim to be kickstarting discussions around concessions rather than moving towards formal complaints against the U.S. before the WTO. And we've talked about this, but in December, the EU and the U.S. reached a preliminary agreement to allow EVs assembled outside North of America to benefit from tax credit, just so long as they're leased rather than sold. And also in the EV context, to your question, we've had something that was really discussed at this convening was the formation of the US and the EU having a critical minerals buyers club, really to team up to address some of that reliance on China that you showed on the page earlier. And under the plan, you'd have sort of the allies, US, EU, UK, maybe Japan, negotiating their own trade agreements first. And once they've figured that out, then they would try to reach additional agreements with third countries, say Ukraine, Zambia, other sort of key third countries on securing supplies of raw materials essential to batteries, other clean energy technologies. So look, like we said, Seth, it's early days, the EU response, but certainly promising directionally. And we're seeing a fundamental understanding amongst policymakers and really across the landscape that to meet the moment, dialogue and compromise are going to be key.
Yeah, I mean, I think any investor needs to reconsider what perhaps valuation of some of these critical raw materials will look like in an environment where perhaps you have frame agreements in order to supply governments who will then pass these materials out into the private sector. I know we have in our portfolio, particularly for rare earth and polysilicon. So just pulling this all together, Neal, a little bit, I promised I'd wrap some numbers around what we think the ultimate trajectory will be here. Bloomberg New Energy Finance, put some new numbers out a couple of weeks ago, noticing that in 2022 we breached $1 trillion of spending on renewable energy and clean energy. In order to meet the Paris Agreement, their estimate is that by 2038 we'll need to be spending $8 trillion. So that's 8% of the global economy, $100 trillion economy, or 40% of capital formation per annum. In my 25 years of investing, I've certainly not seen a market that's going to multiply eightfold, which at the starting point is quite substantial over a 15-year period. And I also have not seen a thematic of that type, which is so relevant to many industries, not just those specifically focused on new energy opportunity set, and not just those companies that are deploying all of their capital towards this opportunity set. And so we're really excited about putting capital to work behind this thematic and feel really privileged to have the research resource that Galvanize has put together. Neal, I think you're a great example of that. But we also have a science and tech team staffed by people, from agencies like DARPA and ARPA-E. And we also have an impact team and an in-house market developments team that enable us as investors to understand these pathways better. I think you could probably reflect a little bit on given you have experience in other houses as well, on how you find being part of our ecosystem.
Yeah, Seth, you're right. I mean, I'd just pull on that through line of impact. I'd say another real benefit of being part of this integrated platform is that we can actually help accelerate those climate solutions. So, of course, we can stay abreast of them and make sure that we're reactive to the trends that we see coming, but also really to help actually accelerate in a very meaningful way. So as you know, just last week, we had White House staff engage with folks across the Galvanize network, along with our friends at Breakthrough Energy and Elemental Accelerator, in a dialogue about all those new building decarbonization policies that we showed earlier, and how to accelerate adoption by the private sector. And I would say we all found value in that sort of engagement, because ultimately, there's a recognition by all parties here that it's going to take real partnership between the public and private sectors to turn these policies, as they're written, into real investment and innovation, which we obviously need.
Yeah. So to wrap up, to give Caitlin some time to get to questions, I think there's 4 things I'd want people to take away. The first thing is this is happening today. Capital's being deployed. Our conversation with companies are material, and they're driving the returns on capital and the cash flows that are being delivered by corporates at the micro level this moment. The second is that pragmatism is winning out. The risk of WTO retaliation and some impediment to getting this capital deployed, I think, is ameliorating. You've made that very clear, Neal. The third is that, the IRA is embedded. Not only is it, part of national law and part of, established through legislation, it's also having an economic impact in the right regions to encourage bipartisan support over time. And finally, the thing I would leave people with is, this is complex. It's complex, it's changing rapidly, and it's impacting multiple industries simultaneously. And so the only way really to attack this opportunity set as an investor is through an active approach to investment. And with that, Caitlin, I wonder if anyone has fired any questions in that we can respond to.
Great. Yes, we have had a few come through. And I think we have time for 1 or 2. Seth, the first one is directed to you. To what extent is this a current topic of conversation with the leaders of companies you're in discussion with? And is it a priority?
Yeah, I think I've touched on this. I was at a global industrials conference a couple of weeks ago, and we probably met 25 companies over a 3-day period. It's in the first 5 slides of any deck that companies are presenting today. I would urge the audience to go and look at the Q4 reports of most companies, but most specifically industrials, from this context. And it's the highest priority with respect to capital deployment for all the CEOs we're speaking with. And that's because there's a fantastic opportunity from a cash returns, profitability, and returns on capital perspective. And it's the biggest single driver of those said returns. And for us, therefore, we think the biggest single driver of the share price over the near term.
Great, thank you. The next question, how should we expect the European response to actualize? What are the anticipated ripple effects from there? Neal, why don't you take this one?
Sure. Thanks, Caitlin. Look, I mean, as we started to talk about, it's still early days of the EU response. But if what we're seeing coming out of Brussels right now is accurate, some of these leaks, it's very promising directionally. And obviously, with all the caveats that we're going to need to see the regular parliamentary and commission processes play out, and whatever changes might happen as through that process and public engagement that will happen over the next few months. But fundamentally, we're seeing an understanding that to meet the moment, they're going to need dialogue, compromise, and the ripple effects of that could be profound. Setting this stage instead of this period that, as Seth alluded to, folks maybe had fear with some of the initial response and rhetoric coming out of Europe in the early days of the IRA, which was maybe going to be a little more retaliatory. What's unfolded is nothing short of the beginnings of a global race to the top. And we hope the ripple effects of that decision coming out of Europe to be more collaborative and add incentives rather than be retaliatory has ripple effects profoundly across markets and for decarbonization for years to come.
Thank you, Neal, and thank you, Seth. And thank you to all of us for joining us today. To keep up with the latest about Galvanize, please visit galvanizeclimate.com or follow us on LinkedIn. If you have any questions or comments about today's conversation, or would like to view the slides we shared today, please reach out to connect@galvanizeclimate.com. We'll see you at the next conversation.